It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by consensuspicks.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at Intermarket Analysis, the trader's ultimate cross-referencing tool. Without further ado, let's begin. The investment world is complex and interrelated, much like the Earth's ecosystem. There are many types of investments, just like there are many types of species. But all investments can be broken down into one of four categories: stocks, bonds, commodities, and currencies. Once divided into these four broad markets, relationships between the markets are evident over time. These relationships are the basis of intermarket analysis. The first thing you need to know in order to use intermarket analysis is a little bit about the global monetary system. Historically, gold was the world's currency, but conversion from paper to gold was halted during every major war of the 20th century. On August 15, 1971, during the height of the Vietnam War, President Richard Nixon closed the gold window, putting the U.S. on fiat money. Since the entire world backed their currencies with U.S. dollars as part of the Bretton Woods system, this effectively put the entire world on a global fiat money system. Why did governments want to do away with gold, which had worked for thousands of years? Why did they suspend conversion during times of war? Well, the answer is that gold puts a limit on what governments can do. If they don't have the gold to pay for something, all they can do is raise taxes, which is never popular. Now, with a fiat money system, governments can print money to pay their bills. The problem with this is that it causes inflation and for prices to go up. When prices go up, this means that it takes more units of a government's currency to buy a particular good. The currency becomes worth less. And if governments aren't careful, things can get out of control, and their currencies could not be just worth less, but worthless. This is what happened in Germany after World War I, as pictured in this photo. So governments have a conflict. They want to print money to pay for their bills rather than taxing, which is unpopular. And they want to spend as much as they can to increase their power. When the government spends money, it curries favor from important blocs. But the more money they create, the less the money is worth, and this weakens the currency and thus their power. It's a balancing act, and it's one that traders can play in the forex currency markets. But since everything is denominated in units of currency, all this money manipulation has effects on the prices of everything we buy, everything from groceries to stocks, bonds, and commodities. This is the basis for intermarket analysis. There are two types of economic environments as far as intermarket analysis is concerned: inflationary environments and deflationary environments. Normally, governments are engaged in the expansion of the money supply, printing more money to increase their power, although they try to do so as responsibly and sustainably as possible. This creates an inflationary period. Inflationary periods normally last many years. But when the inflation becomes unsustainable, then all that monetary stimulus needs to be contracted, and this causes deflation, where prices drop. Intermarket analysis relationships are different in times of inflation versus times of deflation, so it's important to know what kind of economic environment we're in. In inflationary times, which is most of the time, there are positive relationships and negative relationships. A positive relationship between two groups means that when one goes up, the other one goes up, and when one goes down, the other one goes down. A negative relationship means the opposite. When one goes up, the other goes down, and vice versa. Stocks and bonds have a positive relationship in an inflationary environment, as do commodities and interest rates. Stocks and commodities also have a positive relationship. Negative relationships in an inflationary environment include stocks and interest rates, bonds and commodities, and the US dollar specifically with commodities. Finally, there are some predictive relationships in an inflationary environment. Bonds typically rise or fall before stocks, and stocks typically rise or fall before commodities. In deflationary times, when the government has to clean up its inflationary mess, the following positive relationships tend to exist: stocks and interest rates, commodities and interest rates, stocks and commodities. The following negative relationships tend to exist: stocks and bonds, bonds and commodities, and the US dollar and commodities. Here's a graphic to illustrate the business cycle. Each column represents time. Follow the curve. The earliest stage of the business cycle is bullish for bonds, bearish for stocks and commodities, etc. By knowing these relationships, you can make better investments. In conclusion, intermarket analysis is a long-term trading tool, but even within longer-term trends, the relationships are not absolute. There will be moments in an inflationary environment where stocks and bonds should be trading in tandem, but they don't. And there will be moments in a deflationary environment when they should be trading inversely, but they actually trade together. But for long-term trends, intermarket analysis and these relationships have a proven track record. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Consensus Picks. Each week, Wealth Buyer's Consensus Picks software scours through 800+ financial sources to produce a short list of multi-verified stocks. Stocks chosen by more than one of the most accurate stock picking services. Then the Consensus Pick software automatically analyzes the short list of stocks using a series of proprietary filters, and it picks the single best stock out of the bunch. The Consensus Pick. Sign up today for Consensus Picks, and each week you'll be provided with the ultimate alert, a stock that's been independently selected by multiple stock picking resources. A true Consensus Pick. Visit consensuspicks.com to sign up today. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.